Welcome back to the What You More podcast. I'm your host, Quinton Harris, and I'm joined by my co-host today for the March Lending Update, Mr. Daniel Halverson from Bank of England. Thanks for joining us today.
It's good to be here as always, man.
Yeah, man, this is a pivotal episode 150 for us. That's kind of crazy to say because it feels like maybe like less than a year ago we were kicking off the first episode and the first Lending Update, and here we are, 150 episodes later, pretty cool. So in this episode, we're going to talk about home prices. We're going to talk about what happened in 2023. We're going to talk about some new down payment assistance money, affordability for buyers, and as well as mortgage rates like we always do to wrap up this lending forecast. So it's going to be a two-part series. First one's going to be on housing, appreciation rates, what happened, and then as well as some, is it worth paying points, not paying points, and then some down payment assistance programs. So let's jump right into it. So all the naysayers, all we heard all year long in 2023, housing bubble, it's going to burst, you're overpaying for homes, and yet again, and I say again because we heard this in 22, yet again, we had appreciation rates that went up. So you want to speak to a little bit, like how is that happening? Why are we continuing to see this?
Yeah, despite all the doom and gloomers that wanted to call the next housing crash, right? Prices went up, and we did a little bit of a forecast or a recap of, what people thought were going to happen with interest rates, and had to wait a little while longer to kind of get the appreciation data in to be able to talk about what happened with home prices and, maybe what could happen in 2024. But yeah. And there's tons of different data points. We really just pulled this from CoreLogic, which CoreLogic is the mammoth of housing data. So
it's like the Nike of data.
It's a very reliable source, but basically year over year, January 1 to December 31, across the nation, home prices went up 5.5%. So what I thought was really interesting about that, though, is, they track that across every state, and they create this little heat map. Mm-hmm. And there was not one state where home prices went down, although some of them were probably pretty close to flat.
Right.
And some fared better than others, as is going to be the case in a year. But I just thought it was a very interesting thing that, despite all of the rates are going, rates are elevated for the duration of the year. Depending on who you talk to, you get a different take on what's going on with the market. But, according to CoreLogic, they say home prices went up everywhere in every state throughout the country, and the average was 5.5%.
Yeah, that's hard to argue with. And by the way, this heat map, I love it. And if you want to take a look at it, it's going to be on our YouTube channel at What's Your One More. Check that out. Charlie, our producer, does a great job of putting all the visual aids in there that we talk about. He might even pop up on the screen here as we're talking about it. But, this heat map, what's crazy is that, normally we've heard all this boom about the Southeast, right? It's always been like this drive to the Southeast, and it's there, but there's other pockets of the nation that are also doing really well, according to this
Midwest.
map.
Midwest was a kind
Midwest
of a bit of a surprise.
Thriving. You've got some of the West Coast, which I think that's going to be a little bit of a shocker to some people when you see that, especially considering all the negativity you've heard about that. What shocks me on this map is Texas. And I'm going to speak to that for just a second of why I think that's happening in Texas. We've continued to see this. I'm kind of going off script here, by the way. Daniel's looking at me, but we've seen some tax issues in Texas, property tax issues. And I think that's what's adding to a little bit of the less appreciation values there in Texas. And if you're a Texas listener, you know exactly what I'm talking about. There is no, the cap that they have in Texas isn't like what we have in Florida. We got that 3% moratorium. In Texas, it's huge. And we've seen thousands of dollars of increase in people's property taxes in Texas, which is causing affordability issues. And in towns where there's a lot of building that happened over the last 2 years, like Austin, it's an issue. And so I think that's what's causing a little bit of this lack of appreciation because people are leaving the state to go to other states because the affordability is so much tougher there right now due to property taxes.
That's a good point. And I think that you look at a state like Texas, Austin had this massive run up in prices, huge, above and beyond what a lot of other markets experienced. And
right.
That's the case with some of the, the cities or the states on the West Coast as well. Mm-hmm. So they obviously maybe had a little bit of a pullback from that, but even withstanding all of that, home prices still went up.
Yeah. In
the state. Now, obviously we'd have to do a deeper dive into specific metros to tell you, that's the case across some of those areas, but nonetheless, like I said, for all the doom and gloom bros out there, home prices went up, and we spent the entire year with more or less 7% plus mortgage rates for the duration of the year.
Well, I want to point out for the people that get into YouTube and you click on these videos to individuals that bubble burst and they've got these big images on there, and you're clicking to watch it. Like, understand this, like. And you might be saying the same thing. I mean, I have a degree in finance. I've lived in the real estate world for 20 plus years. I would say that I have some level of credentials to go through some of this stuff. There are people that have zero level of credentials preaching doom and gloom about a bubble burst online. So keep that in mind when you're looking at it. And it's one of those things like, what does that person stand to gain by you watching that? Like, what are they looking for? Subscribers, clicks, whatever. But just think about this. It hasn't happened. And people have been saying over 2 years that the real estate's going to go back. It hasn't happened. And it's not going to happen because of a simple formula we've talked about for a long time: supply, demand. There's not enough supply. We are so undersupplied. That's not getting better. It's not going to get better over the course of the next 5 years. And I'm saying that because we don't have enough manpower, enough bandwidth to build enough homes to offset the demand that's coming. You know, it was a couple episodes ago we did with the Vantage Score. We talked about when Vantage Score goes into place in 2025, that's the new credit reporting system, that 33 million people, day one, 33 million people that cannot get a loan today will become loan eligible. They aren't even on the radar of supply right now. They're going to become loan eligible. Like, think about that. Plus the already depleted supply we have. It's a thing. That's why that's not getting better. And I think you're going to talk about what the forecast is going to next year appreciation, but it's positive. That's nothing.
Yeah, so according to CoreLogic, they are saying they anticipate homes to appreciate by 2.6% this year.
Another win
as we talk. So, you know, that's below the historical average, right? So maybe we don't see as much growth as we saw in 2023. Certainly won't see as much as we saw in 2022. But well, I say certainly. You know, I just for a reference point, I went back and said, okay, well, how did CoreLogic do in the past? And they've historically been pretty conservative, I would say, in their forecasting. So last year they said they thought prices would go up by 3%. Obviously, we almost doubled that.
Yeah.
The one that I thought was the most interesting was in 2021, CoreLogic forecasted a 6.6% decline in home prices. And we know what happened there. They went up almost 20%.
Yeah,
so they were over 25% off of their forecast. So all that to say, 2.6% is a shot in the dark, right?
That could be another 5%.
It's their best educated guess based on their data of what could happen. And we've seen listing and inventory increase pretty significantly of recent. So maybe that is part of their logic for why that is maybe going to moderate a little bit.
Sure.
Still not in any capacity to a supply level that would be commensurate with how many people want to buy a home. But, you know, maybe that's part of their forecast, but nonetheless, still thinking prices are going to go up. And this, once again, is based on interest rates that have been, you know, 7% plus in a lot of cases. So I think that the argument of when rates come down, the price growth could accelerate. I think that argument just starts to hold a lot more water. We've been talking about that for, you know, how long? Year and a half plus, right?
At least a year and a half. And two things I'll take away from this. They're underestimating on their estimates, right? They've been off, but they've been off in a good way. So if you were banking on 3.3 and you got 6 or 5.5, that's a good thing, right? If you were banking on -6 and you got a positive 19, that's a really good thing, right? So they've been off. They've been consistently off towards the favor. But I'd like to say this. One of the reasons I think that maybe 2.6, it's an election year. And traditionally speaking, on an election year, what you do is, and we've done that on our chart, we show there's that halt towards the end of the year where homes just stop selling. So maybe they're adding that into the forecast. Who knows?
Yeah, and we're already seeing that at our level at the bank with new mortgage originations. We're already hearing people say, well, this is what I want to do later this year if the election goes this way.
This is the most, we're going to get into a conversation I don't want to get into, and we're going to save this for another episode, but this is the most mind-boggling topic. What was it? I think we were in 2016 when there was when Trump was running against Hillary. I remember, like, I know you do too. We were in the same building. We literally had people call and cancel contracts and be like, man, I just don't know who's going to win this election. And I'm like, you're going to lose your earnest money. They're like, I know. I'm okay with it. And I'm like, as if the president of the United States has anything to do with your house, literally with you buying a house and living in said house. Like, nothing's going to change your house. It's a 30-year fixed rate. There's nothing they're going to do to change that. It's just crazy how many people backed out of that. Like, and we're starting to see it again. It's just, I think it speaks to the uncertainty. You know, people just feel uncertain about this. They get rattled up by the media. It's a whole other episode. I'll stop. I can stop. I'll digress. Sorry. All right. So, hey, we got some cool stuff going on in our city here for those that live in Jacksonville and are local to this podcast. I definitely appreciate you listening and checking it out. But this section's for you. There's some new down payment stuff that's coming out, and our mayor is kind of really pushing us out there, bringing the H2H program back. You want to kind of talk about that and, you know, tell our audience what that is and what's on the what's in store for them. Yeah,
so Mayor Donna Deegan announced, basically, from what I could see, it's going to be $2 million in local funding for down payment and closing cost assistance for people that are living in Jacksonville. So I did a little bit of research here. You have to show proof of residency in Duval County for at least 2 years preceding applying for this. So they're obviously targeting making homes affordable for Jacksonville residents, right? And we don't know necessarily how long $2 million will last, or some of the details of that program. We're probably, by the time this gets dropped, probably about 2 weeks away from having all the finer details. And this is just another arm of the city's down payment assistance programs that are currently existing. But with this program, the income limits are much higher than what is available right now. So we'll open up to more to more people, and they're anticipating about 200 families will benefit from this.
Hey, I mean, that's 200 families that maybe weren't going to get help before. So I mean, 200 is 200. That's nothing to kind of like just, downplay. I think that's a big number, and I love the fact our city's doing that.
Yeah, and it is very much targeted to affordable housing, which is why their income limits. The sales price of the property cannot exceed $335,000. So they're very much targeting affordable housing. That's kind of in line with median home prices, right?
Isn't that crazy? You think 335 is affordable?
So, we used to jump up and down when we saw
that used to be a much different. It used to be that I'd even say that I'm getting tongue twisted. Affordable housing 335. That's a whole other podcast, right?
Yep.
Keep going.
Yep. So it is for first time home buyers. The other thing that I thought was interesting is the way that this is going to be structured is essentially the assistance. And there is a typo in here, so I apologize. Those of you that have already read this and got excited, there is one typo. Essentially the program will provide 75% of the total amount of the down payment or closing cost, not to exceed $25,000 per household, which essentially would be very difficult to exceed based on these parameters. But it's 75% of down payment or closing costs.
Right, not both.
And the way that the repayment works is essentially if you sell that home in the first 3 years, you have to pay back the assistance that you got.
Okay.
If you sell it after 36 months, you have to pay 10% of your net proceeds back.
Okay.
Which initially when reading that, I thought, well, that's a lot. But then I thought about it. I mean, if you use an example, let's just for round numbers, say you buy a $200,000 home, you do a 3% down conventional loan. So that's $6,000 of down payment. If you get 75% of that, that's $4,500. So you're going to get $4,500 towards your down payment. And let's say in 10 years you sell that home and you make a profit of $45,000. Well, you're going to pay back $4,500, right?
Correct.
So it actually is, the way it's structured, actually it's pretty favorable.
And then after 15 years, it's forgivable, right?
Well, that is specifically on a different program. It's my understanding that this is not forgiven.
Okay.
That money, that 10% that you're going to have to pay back of your net proceeds, not your gross, of your net proceeds just goes back into fund this. So they obviously want to make this something that is going to be funded relatively continuously into the future. So at first glance, in reading that, I thought, well, that doesn't sound like a good deal. But then you work through the math and you say, okay, well, you're probably not going to have to repay more than you got unless home prices go up considerably. And if you are in a position where you can sell for considerably more than you paid for it, I don't think anybody's going to be upset about that.
Right.
So
No, that makes complete sense.
All in all, I think it's something that it won't work for everybody, right? Just like all of the down payment assistance programs everybody doesn't fit in that bucket, but it's a great thing that they're doing. And you have the ability to advertise and have the ability to offer to people that live in Duval County and want to continue to live in Duval County and need an entry point into homeownership.
Well, and we talked about this, Charlie, I think we just recorded an episode on like parents helping out their children financially. Man, this speaks to that generation, as the study shows, that 63% of Gen Z and 59% of millennials, saying they plan to buy a home, but financially speaking, it's difficult, right? I think the number one thing holding people back, it isn't necessarily rates as much as it is just affordability in general. That's the combination of the house and the rate and homeowners insurance, and the list goes on and on. This is another thing that can help out with that. And Daniel, if someone wants to get more information about this program, they just reach out to you at Bank of England. Is that the best way for them to do that?
They can reach out directly to our team. Absolutely.
Okay.
They call us at Bank of England. We can give them the details. And then within the next couple of weeks, we could get to the point of having them submit an application to determine what they qualify for.
Yeah, and we'll have a link on our YouTube channel here to get into BOE Jax to get more information on this. But this is going to be a big deal because not every lender is participating in this. I want to make that abundantly clear. There's going to be a select few people across the city participating in that. So keep that in mind.
I'm sure they've gotten probably 10x the interest that they had before this announcement. But yes, it will be limited. And the good news is you're probably going to be working with companies that are lending heavily in Jacksonville that would be interested in this. So you're going to be working with a local lender. It's a great thing. The lenders on there, I'm sure it's going to be a list of really, really good companies. So, but to your point, I threw that study in there. I thought that was super interesting that 63% of Gen Z and 59% of millennials said they plan to buy a home in 2024. And I think for Gen Z, more so than millennials, the affordability is a major concern. So I thought that it was, if nothing else, just interesting and refreshing to know that 63% of Gen Zs are interested in buying a home.
And just for people, that's 18 to 27-year-olds. So keep that in mind. I mean, you get a younger group coming in there saying, listen, I'm ready to buy a home. The average first-time home buyer has always been statistically labeled between 32 and 35. So to have that younger generation start thinking about real estate, that's a good thing.
Maybe they've heard our podcast about how it's not going to become more affordable for them.
Man, maybe. And you know, we're going to dive into that here in the second part of this episode. But as we wrap this episode up, so hey, I get asked all the time. I know you too. I have people pause and come ask me, hey, should I buy down my rate? Should I take a look at paying what we would call in the industry, people all use the word points, right? Should I look at buying down the rate to get the best rate or to basically help me get the lowest payment? And I think that's a loaded question because there's so many variables that go with that. That's not a just quick yes or no. In this section of the lending update, I love how you tackle this and essentially say that, you know, that's not for everybody, but there are reasons why to do it. Do you kind of want to elaborate a little bit on that?
Yeah, I meant to put this article in there the last couple of months and just kind of slipped my mind, but I read this article from Freddie Mac a little while ago, and I thought it was interesting. But to your point on does it make sense to buy my interest rate down, it's a conversation we have a good bit, and obviously having the conversation of rates are probably elevated right now relative to what they're going to be in the future. Mm-hmm. So that's a consideration, right? It may not make sense to pay points with that in mind, but you also got to keep in mind, you know, any money manager is always going to tell you keep your money in the stock market, even when it's taking a beating, right?
Right.
But there's also what helps you sleep at night, right? So for somebody that wants their payment in a specific spot to feel comfortable buying a home, then maybe points could be a good option. For people that want the upside of refinancing, probably doesn't make a lot of sense to sink money into paying points. But this study essentially was, I think that it was 80 LTV conventional loans. Mm-hmm. And basically, the first thing that was eye-popping is 58.8% of purchase mortgages had points on them last year, which was up from 53.6 in 2022, but up from 31% in 2021. So that number's almost doubled from 2021 to 2023, which just tells you rates more than doubled.
Right. I was going to say, most people weren't paying points in the 21 era.
It makes sense, but that was an eye-popping number for me, especially I got in the business in 2011, right after Frank Dodd, and it was almost like a curse word to say points. That was the first question that somebody would ask you is do you have points?
Do you charge points?
I do not want to pay points. So we went from being terrified to sell points to now more than half of people that buy a home want to buy their interest rate down.
Well, do you think a little bit of that has to go with saying, like, do you think some of that has to go with like the borrower's psyche where they go, oh, I got the best rate, or I got this rate? Like, it's so funny how, like, I think millennials and Gen Zers and some Xers too, we open up about our financial conversations at a dinner table with not complete strangers, but people that aren't family or people that aren't in your circle, maybe your acquaintances, right? And you'll start rattling off like an experience about a car or mortgage or a credit card. And I think people are just so open about their finances, whereas I think my parents and definitely my grandparents, that was very like faux pas. Like, you did not talk about finances. You never asked anyone about what'd you buy? What'd you pay for that? You would never ask someone that. You might get smacked across the table if you ask that. In today's world, it's like people are proud of it, right? And so I think this whole dynamic of I'm a good credit person. I know how to go get credit. I know how to go get a loan, and therefore I got this rate. And do you think some of that plays into it? Like people wanting to outdo someone or outdo the market on the rate, like I won, something like that?
It could, and I liken it to the story about the fish. You catch a fish and then you tell somebody else the fish was twice as big. It's funny, people will say, oh, I got a 5.5 rate, and it was 6 and a quarter, right?
Right.
I got a 4.5 rate. Well, that was 5, but so people always say they got this rate that's way lower than they thought they did.
Right. As if that makes them some superior person at the table, right? Like as if the person sitting across from them, A, cares, or B, goes, wow, how did he do that? Like, man, he or she must be really good at lending and negotiating terms and conditions.
And then that other person calls their lender and asks them why they didn't get that rate, right?
Right.
I think that's part of it. I also think that no matter where rates are, 6.875 sounds better than 7.
Right.
5.875 sounds better than 6. 2.875 sounded better than 3 for a lot of people that wanted to wait until they got in the 2s, right? When rates were at all-time lows, as if the difference between 3 and 2.875 was worth potentially missing out. But I think that's part of it. I think that obviously rates are higher. What's interesting in this study is that the people that did not pay points got a lower average rate than people who did, which all you can make from that on the surface with this study is that the people that were paying points presumably had lower credit scores than the ones that did not pay points.
Yep.
So we're not going to turn this into a, financial literacy or a profile of borrowers, but I thought it was interesting that it appears that people are buying down interest rates on conventional loans when maybe the credit score is a little bit lower and thus the rate's a little bit higher relative to the market.
Right.
And, as I thought about that, one thing that immediately came to mind is we've been in this market for a while over the course of the last probably 3 to 5 years where a lot of transactions, either sellers or agents are concerned about FHA loans in comparison to conventional loans. And to the point where a lot of times an offer won't be accepted if the buyer doesn't do a conventional loan instead of an FHA loan.
Right.
And some of that is probably not necessarily accurate or applicable in terms of some of the concerns. I think there's a lot of misinformation out there about FHA loans compared to conventional loans. But the immediate thing that came to mind for me about that is I think a lot of those buyers probably would have been more suited for an FHA loan and gotten a lower rate in payment
Than a conventional
loan. And that was something that it kind of immediately caught my eye when I saw that is, man, how many of these people probably would have been better off doing an FHA loan and felt compelled to do a conventional loan because someone told them that was the better loan to do.
Because traditionally speaking, that's always been like what you've thought or what you've been taught, right?
Yep.
So like if I'm a real estate agent, I want to take away from this that, hey, listen, the enigma that I may have about FHA, okay, maybe let's start to kind of let that go a little bit because FHA is going to get you the lower rate without all the points. And it's going to eliminate all of those loan level price adjustments we've been talking about over the last couple of episodes of the lending updates. So just kind of keep that in mind that if you're FHA, it doesn't mean necessarily a challenged loan. We're searching for the best rate and trying to get the customer the best deal.
Well, and the other thing about this study is this was 20% down. So you'd also come into I'm putting 20% down and thus I don't want to pay PMI.
Yep.
But we've run the numbers quite a bit with some of our originators at the office here, and somebody with a maybe not stellar credit score, the rate differential between conventional and FHA could be 1.5% difference in rate. So then you factor in the mortgage insurance and it's still way cheaper to do an FHA loan, and you don't have to look at paying points. So it's just something that I immediately kind of caught my attention and thought back to all the conversations that I hear of transactions where seller or whatever the situation is, they don't want to move forward with an FHA offer. They want the buyer to go conventional.
Right.
I'm wondering how much of the conventional loans was attributed to that, or this, I've got enough money to put 20% down and I don't want to pay PMI conversation.
Right. Well, we'll see as the market kind of maybe transitions to more of listing agents having to examine those deals as they come through. That's something that they should definitely take note to, that the FHA is a deal right now in this market where you're actually searching for the better rate in terms versus maybe that traditional 20% down conventional. So keep that in mind. Hey, before we wrap up the show here, Dave, what rate do you have on your mortgage? I've got a 275.
That's right. It's negative 0.5%.
I got it from the Euro banks over there. It's
That's
negative.
Right.
All right, guys. Hey, if you like what you're hearing, please tune in to podcast. Check us on our YouTube channel. What's Your One More? We're on every podcast platform you listen to your podcast on. Also, What's Your One More with number 1, and on our socials as well. Till the next episode, we're coming back to back. The next one is a full rate breakdown. What's going on? A little wrap up of the Federal Reserve. What's to come? And we will probably debate what we both think is going to happen here in the next Federal Reserve meeting. So thanks for tuning in, and we'll see you at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.